All right, let's get into it. We need to talk about this massive puzzle taking shape for 2026, which is this huge disconnect between a stock market that's just on fire and an economy that's, well, showing some really serious signs of stress. You've got two completely different stories being told right now, and we're going to try to make sense of them both.
Okay, so let's start with the market side of things. If you just looked at the headlines, you'd think everything is fantastic. I mean, the projections for the S&P 500 are more optimistic than they've been in years. On the surface, it really looks like investors are betting big on a great year ahead.
But, and this is a big but, that's where the story starts to get really complicated. Because when you dig down just one layer, you find out that the very same experts who are cheering on the market, they're also the ones pointing to these huge, flashing red lights. And that is the central conflict we're going to unpack today.
So let's kick things off with the good news, the story that's been all over the place. And it's a story that's pretty much being powered by all the excitement around one single piece of technology. You guessed it, artificial intelligence.
Get this. A major survey of global investors from Deutsche Bank found that, on average, they expect the S&P 500 to gain almost 7% in 2026. Now, to put that into perspective, that is the most bullish, the most optimistic forecast they've seen in the last 4 years. That's some serious confidence.
But here is where the twist comes in.
When you take those same super optimistic investors and ask them, okay, but what really keeps you up at night? What are you actually afraid of? A very, very different picture starts to emerge.
And just look at these results. The number one answer is pretty shocking. 40% of investors, and that's by far the biggest slice of the pie, they believe the single biggest risk to the entire market is a crash in AI and tech stocks. So the very thing that's driving all the optimism is also their biggest fear. It's a total paradox right at the heart of the market. Yeah, and this isn't just a minor concern. The strategist who ran the survey, Jim Reed over at Deutsche Bank, said he has never seen one single risk dominate a year-ahead forecast so completely. In his words, this fear of an AI bubble literally towers over everything else. Wow.
So if the big fear is this tech bubble bursting, what's actually happening on the ground, in the real economy? Well, if you peel back that shiny surface of the stock market, the foundation, I'm talking about the financial health of everyday people, is starting to show some really deep cracks. Let's look at the numbers. The latest report from the New York Fed is out, and it is a doozy. Total household debt in the U.S. has just hit an all-time record of $18.8 trillion. I mean, that is just a staggering number. That's every mortgage, every car loan, every credit card bill in the entire country all rolled into one.
And when you start to break that number down, you can really see where the pressure is coming from. We're talking about a record $1.28 trillion just on credit cards, another $1.66 trillion for car loans, and the exact same amount again for student loans. This isn't just one problem area. It's like people are getting squeezed from every possible direction. Consumers are stretched incredibly thin. And it's not just the sheer amount of debt. It's about being able to actually pay it back. Right now, 4.8% of all of that debt is in some stage of delinquency. That means more and more people are falling behind on their payments, and that rate has now hit the highest level we've seen in almost 10 years. So this incredible pressure on the consumer, it's happening at literally the worst possible time. It's happening just as all the ingredients for this dreaded economic scenario, the one that policymakers have nightmares about, are starting to bubble up. And that nightmare scenario is called stagflation. It's this toxic, painful mix of a stalled-out economy and stubbornly high prices. Think rising unemployment at the same time as rising prices. And with the latest jobs report showing a surprise loss of 92,000 jobs, while at the same time crude oil is surging to $88 a barrel, while you're looking at the textbook recipe for it. And this right here perfectly illustrates the trap the Federal Reserve is in. See, to fight rising unemployment, their go-to move is to cut interest rates to get the economy going. But that would just pour gasoline on the inflation fire. Okay, so to fight high inflation, they'd raise rates. But doing that would almost certainly make unemployment even worse. They are completely stuck between a rock and a hard place. So you've got consumers struggling, the Fed is in a bind, you'd think the stock market itself would be showing a little bit of caution, right? Well, this is where it gets even stranger. Some of the most trusted old-school market indicators are starting to flash bright red. Take one of the most famous valuation tools out there, the Buffett indicator. It has just crossed 220%. Now, for some perspective on that, that's a higher reading than it had right before that pretty significant market drop back in 2022.
So what is this thing? Well, it's actually pretty simple, but it's powerful. It just compares the total value of the entire stock market to the country's gross domestic product, its total economic output. It's asking a really basic question. Has the stock market gotten way too far ahead of the real economy? And right now, its answer is a loud and clear yes.
So we've got consumer debt, we've got stagflation risks, and we've got sky-high valuations. These are all the risks we can see coming. But what about the ones we can't? On top of everything else, you have the wild cards, these unpredictable, game-changing events that analysts like to call black swans. A black swan is basically something that just comes out of left field and changes everything. It's one of those high-impact, low-probability events that nobody really sees coming. By definition, you can't predict what it's going to be, but you can definitely look for cracks in the system where one might pop up. Here's a really interesting potential black swan analysts are watching for 2026. What if the market permanently stops relying on official government economic data? After a government shutdown forced markets to use private data sources, things like credit card spending trackers or private layoff reports, another shutdown could make that switch permanent. And that would create a much more volatile, uncertain world where everyone is trading on completely different information. So, after all that, where does this leave us? Well, it leaves us right on a knife's edge, basically trying to balance between two completely contradictory stories about the economy, each one pulling in the total opposite direction. The bull case is crystal clear. You've got a market powered by this incredible AI revolution with the strongest forecast in years. But man, the bear case is just as compelling. You've got the American consumer drowning in debt, the looming threat of stagflation, and these classic valuation metrics that are just screaming that we're in a bubble. And that really leaves us with the billion-dollar question for 2026. Is this high-flying market standing on a solid foundation of real technological progress? Or is it just dancing on a trapdoor, completely unaware of the shaky economic reality just a few feet below? The answer to that is going to define the entire year ahead.